G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and I run a mortgage broking business called Atelier Wealth, where we specialise in helping property investors start out and scale up their property portfolios. And what I love to call is the ambitious property investor. So someone that's looking to self-development, invest in their knowledge. And that's why we bring in someone that we call best in breed, because they have the knowledge, they have the insights and the coalface of their particular line of work. And today is a great friend, all-round good bloke as well, well-travelled man, Steve Palise from Palise Property. Welcome on.
Thanks, man. Thanks for having me back in the studio, which is nice as well. Not in Europe.
Correct. Well, we're going to touch on Europe in a second. Before we do kick off, just want to reiterate, this is a chat that's general in nature and not intended to give advice. So please do seek out a professional. And we're just talking about that exact dialogue before, mate. I mean, we're here to talk about your world, which is commercial property. Mm-hmm. And I think that, we actually want to impart some knowledge and some wisdom. So take what Steve says, look at your own situation, but we want to absorb everything that he's kind of putting out there, because you've been doing this for quite some time and you've been helping so many commercial property investors kind of scale up. We want to get inside your head.
Sounds good.
But before we do kick off, you mentioned just before, the last time we did this, you were in Europe. I've seen your social media, mate. You're bloody gallivanting all over Europe, having a good old time. Now you got a 4-month-old. Take us through life. How's it been and how's it changed?
Life's been cool. So I've been, 2.5 years in Europe.
Wow.
Did 15 different countries. Weirdly, when I released my commercial book, that's when I went over to Europe, and I had every friend and buyer's agent being like, "What are you doing, Steve? You're an idiot."
Not a good time.
This is where you expand your business. And now we're under contract on 40 properties at the moment, and I've got 13 staff, and it's kind of all accelerated from there. Weirdly, going to Europe was the best thing that happened for the business. And we chat about this like personally, about growing business and things like that, because it forced me to treat my business like a business. I had an availability from 1 p.m. till 9 p.m. Australian time. That's when I had to do all my work. Then I also had to hire people for the other time and trust them to actually do it. So then getting the right systems in place, the right people, the right processes, and even focusing on like no longer just doing the networking, going and like having coffees with lots of people. It was like, cool, how do I get to lots of people on social media? So I was do educational content, videos, books, free downloads, spreadsheets, and it actually just forced the organic growth that way.
It's fantastic. You're spot on. Look at any business. I mean, when we just take a small holiday. Team step up. They love it. We're not snooping around. But also, I think clients get a different experience as well, because if we become the centerpiece, they're not accessing the rest of the IP in the team, or a different way of delivering, for example, as well. I think it becomes like a magic recipe, like get out of the way and let it grow.
And like with commercial property, I'm selling the dream of passive income. So it'd be very weird for me to be working like some buyer's agents 12 hours a day, sitting in the office being like, oh, but I've got a 200 grand passive income. Who cares? You're not spending it. I grew a passive income because I love travel. I like hiking, rock climbing, and traveling. So why would I not do that? And then weirdly, I get trust. So like the more I was traveling, the more people go, oh, maybe Steve's legit. Maybe that guy who's like tatted up wearing shorts is somewhat legit. And even like with sales calls, like I no longer had to do the hard sale. If someone wasn't interested, I'd be like, oh, all the best. And then all of a sudden they'd be like, no, I want to work with you. And you're like, well, all right, make up your mind. So I found stop doing a hard sell and just give content and education like this stuff, and it just comes back to you.
When we give away our knowledge, and this is purely what this podcast has always been, started out with commonly asked questions, and we still get some great questions, but now it's like, hey, mate, we're sitting on a mountain of knowledge. We've got access to great people here. Why don't we share it? And that's we're getting some really good feedback from listeners as well. So that's what I really want to kind of have a chat to you today. So we'll go through commercial, we'll go through kind of where we are at the moment. We'll go through what the future looks like as well. But right here, right now, what are you seeing from a commercial property perspective, Steve?
So vacancy rates for commercial, all-time low. So like literally all-time low. Most capital cities, we're 0 to 0.5% vacancy rates.
Okay.
So even where we are now, we're in North Sydney at the moment. 0% vacancy rates in industrial property in North Sydney at the moment. So like a lot of people will say, oh, don't touch commercial, it's too high risk. Yes, for office space. Yes, for some retail. But there's certain sectors you can have low risk. So most of what I'm buying at the moment is industrial around Australia. Because vacancy rates are so tight. I still buy retail, like medical centres, cafes, hairdressers, stuff like that, where you have the need there. But as long as you know what you're doing, you can buy really well. But just run around the grounds. You'll get your best yields in Brisbane and Perth for capital cities at the moment. Probably followed by Adelaide, Sydney and Canberra. Melbourne's the lowest. And then Tasmania is a bit of a regional town, even though it's a capital city, so it's a bit of a different one. But that's kind of the order where you'll get.
Okay.
I'm buying a lot in Brisbane and Perth because there's really good bang for buck. You get like 6-7% net yields, whereas Sydney, you're probably talking 5 to 6. Melbourne, you're talking 4 to 5.
Why is Melbourne so low at the moment?
Why is Melbourne rents and yields so low? It's just this lack of demand, and like the state's in debt. What is it, $1 billion or something like that? So there's just less of demand, less drivers, but it's just supply and demand. That's where prices come from. It's where rents come from. But I just don't see the need to buy a 3% yielding commercial. Like, what's the point? I'd rather go buy a 5% gross yielding residential, which will end up somewhat similar with slightly lower risk.
Yeah, okay. You touched on resi there for a second. It's probably the common, and we hear it when talking to our existing clients. You probably have this in your initial calls. Resi versus commercial is almost a bias, and sometimes a confirmation bias, one particular over the other.
Yep.
How do you unpack that conversation with someone going, oh, look, I think I just stick to resi because that's tried and tested, versus commercial feels like we're uncharted waters sometimes.
Most of the time it's a misconception for myths. So the biggest misconception is you're going to have big periods of vacancy for commercial.
Yeah.
Yes, if you don't know what you're doing, you're going to have a huge vacancy. You go buy regional Australia and there's an oversupply, it will sit there vacant for years. But like I just mentioned with Sydney and Brisbane, that vacancy rates are sub 0.5%. So that's one myth. The other one is you need a bigger deposit, which is true, but you can get 80% loans. You can't get 90% with lenders mortgage insurance, but you can get 80%. Most of the time it's 70%. But as a forefront, like, you will get the exact same capital growth with commercial as you do as resi. So that's probably the third myth.
Okay.
And anyone who tries to argue this point with me, I have an easy way to shut it down. If residential grew more than commercial, why is residential not more expensive? Because over 30 years, 2% more growth per year on year, it should be 3 to 5 times the price. But most people say commercial is too expensive to get into. So how did it get expensive if it doesn't have the same capital growth? Nice. The myth comes from different commercials grow at different rates. A high density office with no land component is going to have less growth than a freestanding warehouse that has a land component. Same as residential. Freestanding house grows more than a high density apartment. So there's people this bucket in certain commercial. I get it on social media. If I do a post about anything with commercial, the keyboard warriors come in and be like, yeah, offices are sitting vacant everywhere. And I just respond with, don't buy office. There's other options.
And there's, again, you talk about resi versus, you talk about different asset classes in resi. You can do more to a house than you can to an apartment. Like you can add a mezzanine to a commercial warehouse, for example.
Everything you can do to a freestanding house, you can do to a commercial plus more, because you've got multi-tenancies, you can put solar panels, you can put ATM machines, you can put telecommunications, you can put mezzanine areas, office space, subdivision, build up. I've got a cafe in Brisbane. I'm building a residential on top of the cafe.
Nice
so
one.
There's all those other options. I don't want to sugarcoat it though for the listeners. Like there is way more.
The next part that I want to go to. Let's lift the hood on kind of, because this is not, even if it's resi, it's not passive. You mentioned about passive income. There's a certain sense of being active in these with your portfolio as well, right?
Yes and no. Certain commercial are very hands off. If you go buy a warehouse in Sydney and it's 3 concrete tilt-up panels and a roller door, it's not much. The property manager, they've got to do their job and check like fire compliance and do all the inspections and
standard across. Like
nothing can really go wrong. It's some concrete walls, whereas a house, it's always a bit of maintenance bills here and there. So it just sort of depends where you're buying, but where it's not passive is actually doing the work to find a commercial. Like, just to put it in perspective, I'll read off some stuff. Like, just looking at a commercial, you got to do lease review, contract review, tenant interviews, foot and road traffic analysis, business analysis, interview the tenant, vacancy studies, occupancy studies, check leases are registered, check fire compliance, checks asbestos registers. I do a credit history check on the tenant. I interview competing businesses in the area and then look at what other complexes are in there. Talk to a town planner to find out if they're building any competing types of like businesses or buildings nearby. My due diligence report is like 60, 70 pages long as a minimum. Residential, no offense to resi, because I personally own 8 residential as well, is check floods, check housing commission, don't buy greenfield, get a good kind of area with some value add potential. Like, that's pretty much the bulk of what you do. The argument with the resi buyers agents and resi investors say is choosing the area is the hard one, because that's where you get the capital growth.
Yes.
Buying a negatively geared property, you are banking on that. I want to get that plus the cash flow. So I can analyze the cash flow because I know what it is going to be now. So for me, commercial, you get the same capital growth, way more cash flow. It's a much better performer, but you need to know what you're doing. Like you can burn yourself massively if you don't.
Okay. So the argument then So if you say, look, I'm a rookie or I want to DIY versus done with you or by you, what is the difference? You've probably seen test cases where you had clients that, look, I'll just do it myself instead of balking at a fee. And
you 9 times out of 10 you might be all right, but like I sell my services a little bit as like I can do the whole clickbaity stuff if I get under market value, off market, all that stuff, but I don't do that. I make sure you don't make a mistake. Yeah. Because that 1 in 10 time, if you get it wrong, you've shot yourself in the foot and you can't invest. Like imagine if you buy a commercial and in a year's time it goes vacant for 2 years. You can't do your residential investing, and all of a sudden you've got $1 million asset or whatever it may be
cash flow
with no income, zero. Right. At least with residential, you're probably going to have a tenant for most of the time. So it's the risk. I try to just say to people like, I do get access to off market and that, but it's for making sure you don't make a mistake and like we're checking everything that we actually know. So it just depends what you're after.
Cool. And so yes, you've been really fortunate to put out a couple of books, for example. So you did the resi and the commercial property explained as well. How's that gone for you?
Yeah, going really well. I think we're 22,000 copies sold now.
Awesome. I
hated writing a book because like the commercial one I did first, I was up every night for 3 hours for about a year. Wow. But then this is a first world problem, but like what happened was everyone started just putting me as the commercial guy. So anyone who had a conversation with me was just like, oh, you're going to push me to commercial, you're the commercial guy. I'm like, no, I've got lots of resis. I've purchased about 1,000 residential properties. I like resi, so then begrudgingly I'm just like, I need to write a resi book so people don't think I'm giving them biased advice.
Yeah.
Because that's what most buyers agents do. They always find their niche because it's easier to make noise on social media. So they're always the cash flow guy or the Brisbane guy or the regional guy or the granny flat guy.
Buy 10 properties in 10 years.
Buy 10 properties and they always got something. Yeah. I don't want to be known, I used to be a structural engineer. I want to be known as guys just gives like good, honest advice. And the biggest question I get, and you might even ask this, is when's commercial right for you?
That's exactly what I was going to talk strategy.
Yeah, most people come like, oh, should I buy commercial yet? And that's the question you kind of need to go over.
Yeah. So if that conversation does come up, so we talk strategies, and so I mean we're hell bent on trying to build more, property millionaires, building intergenerational wealth through investing in quality assets and building a high performance property portfolio. So when does commercial become a really good addition to the portfolio, do you think?
Yeah. So it depends on what your goals are. So the 3 questions I ask every person is what you're trying to achieve, over what time frame versus what you've got to work with. And what I mean by that is talking to a broker like you and finding out like borrowing capacities, because sometimes you've got a much bigger borrowing capacity for residential. Because let's use a case example. So if I get a 20-year-old client, they say, oh, Steve, I want a 50K passive income. I want commercial because it's going to give me much bigger passive income than resi. Yeah. I will talk them into residential because I'd say, look, if you've got aggressive and you've got banker mum and dad to fall back on, go get some 90% loans. Go accumulate. Get 2 or 3 residential properties on 90% loans versus 1 commercial on a 70% loan. We've got 3 times the portfolio. If it grows exactly the same, we've got 3 times more wealth to then put into a commercial 3 times the size. So that's more right for them. If you come to me and you're 63 years old and you're talking about retirement in 3 years' time, how is me buying you a negatively geared residential property going to help you? Like 10 grand. It would have
to shit lights out from a capital growth perspective. Would be the only strategy that you'd.
But if any buyer's agent or any investor says they can guarantee capital growth in 3 years, run a mile, because if there was that easy, we'd live in the Bahamas on a private island. So it just depends.
Or you'd be caravanning around Australia like you do.
Yeah. Well, but again, it just depends what you want. Like I checked out mental a little bit, and instead of sailing on a $20 million yacht, I drive like a $20,000 camper van. Like it's that balance there. But so finding out like what they've got to work with. So i.e. the borrowing capacity is a big part, and then what time frame we want to do it over. So like you won't build a 50 grand passive income or 100 grand passive income in resi in 5 years' time. It's impossible. Any people that say, oh, I'll build a 100K resi portfolio, you need to have like a 12 mil portfolio, and that's going to take 10, 12 years. Even if you bought, let's say, a neutrally geared portfolio and you had 100 grand worth of rent coming in, that rent's got to double before you actually have that passive income. Okay. And rents generally double every 7 to 12 years. So that's a 7 to 12 year plan. Whereas if you buy like $1 million commercial on a 6% net yield, that will pay itself off in about 12 years. So 60 grand that doubles as well, you've now got 120 grand. So what you've done with like a 5 to 10 mil portfolio in resi, you've done it with a 1 mil commercial. So that's the benefit. But what you're trying to achieve over what time frame versus what we've got to work with. Normally what actually happens is a lot of my investors come with 2 or 3 properties and they're like, I'm out of serviceability. I can't borrow anymore because of serviceability. What can I do? Commercial offers like lease stock loans and things like that. So you might be capital rich or equity rich, but you can't borrow. But commercial's got some obviously higher leverage, lease stock loans, even just better borrowing capacity, because when banks do their shading, it looks much more attractive as well. So that's when they'll kind of shift out of necessity more than anything.
Yeah. You touched on bank policy as well, which is probably something where the dial really kind of turn up a fair bit with bank policies. I shared with you one of our recent podcasts is where Bernie and I bought a commercial office for our team, and going through that, being self-employed and then going through commercial, I was blown away by the different type of options that we had. And we could literally leverage against our home at 100% if we wanted to. We could lend against the business. There were so many ways to stack the deal up, and what you needed to, and Bernie and I spoke about this, was to find a really savvy commercial broker or a banker that really understood.
Bernie is very qualified. I've worked with her personally. She knows what she's talking about.
But it takes that level of speciality. But banks, we're coming back to that, which is lending policies have really kind of dialed up. And you've probably seen that as well when clients are now coming to you going, they're probably frustrated or on the fringe before going, actually, there's a couple more policies that have really kind of
and I think making sure you're speaking to a commercial savvy broker is the most important, because a resi broker is always going to say they can do it because they don't want to miss out on a commission, but they'll fumble around with it and it's always a nightmare. Commercial is different lending. Sometimes you actually need to know someone at the lender and you call them and then they'll give you we can get this done. And so you kind of put your pile, your notes on the top of the pile.
Commercial is, you put it in, there's not the strict policy that there is with resi. So tick, 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 it's approved. Versus it's like, hey, can you argue the case here? Can you sell this deal in? Is there conviction in this, for example? And then there's more grey areas as well, which is not there in resi. It's black and white.
Resis sometimes will have some postcode restrictions, and that's about it. And that's kind of it. And most of the time, it's rational to have postcode restrictions.
Borrower restrictions, or
they don't want you to buy in like a mining town where the mine's closing down and stuff like that. Commercial still has that as well. They'll even have certain assets that they don't like. So specialized assets like petrol stations, cinemas, car wash stations, stuff like that. Childcare, that gets put in a different pile because it's a different risk profile to say like an industrial warehouse. I never really have an issue with like finance because I've actually got a value in my team. So we know what the banks are looking at, but it's just they want to see good tenant, good location, good infrastructure spending, low vacancy rates, versatile premises. They're banking their risk. That's why you pay a high deposit. They're hedging their bets of if this turns sour, we can sell this for 30% less, for instance, and get our money back.
Right.
And that's why, because it is high risk.
Perfect. So what does the outlook look? So, we're coming into another rate rise, for example, coming to the new year. Yeah. What are you hearing, boots on the ground, what are you hearing and seeing for the future of commercial?
All right, so I'm going to give you two predictions here. Okay. So weirdly, every time interest rates go up, I get more interest for commercial because people that look at their resi portfolio go, I don't want to pay 20 grand a year negative.
Yes.
Whereas commercial is still neutral to positive, even with really high interest rates. Like on a 70% LVR, interest rates need to be about 9.5% for a 6% yielding property to be negative. Okay. So I get more interest there. But to answer your question, there's two scenarios I see play out. The first ideal one is because vacancy rates are all-time low, we're seeing record high rent increases.
Right.
So like rents went up like 10 to 15% last year for industrial.
Yeah.
I can see that happening for another couple of years while the demand's still there. If interest rates keep going up, sentiment drops. So the price will probably stay the same because like the rental increases should cancel out the interest rate rises.
Yeah.
Ideal situation, and I don't think this is going to happen, but is interest rates come down in the coming year, and because rents are still going up and all of a sudden the 5, 6, 7% become 8, 9%, that's what's going to give us a big kick of capital growth. My prediction is we're going to see the same interest rates for the next 2 or 3 years. The rents will kind of creep up a little bit or make it a bit more attractive for investors. And then we'll kind of go. The whole thing I say is like interest rates are controlling the market because the macro data is too strong. Same as with residential. Like the government's doing it because people are going absolutely nuts. So they're buying things on the edge of the affordability. So it's the only way they can calm it down.
Yeah.
So I'm actually weirdly in support of high interest rates. I actually want the market to be steady. I want to have like 5% growth year on year on year. I don't want to see a market that jumps by 30%, drops by 15%, jumps by 30%. So I think we're just in a bit of a stable market for the next 2 or 3 years. But so I tell my investors, buy when you're ready, buy when your finances allow, buy when you're educated.
Yeah.
Like you won't pick the market to a year or two. How many of your clients said, I don't know, Sydney was going to boom during COVID?
And then it was going to fall with the fixed rate cliff this year. And we're seeing them rebound again hard as we round out 2023. And to your point around rates, and this is kind of, there's been whispers or murmurs, obviously a rate cut kind of maybe first half of next year. But I think that ship's kind of sailing at the moment from what we're hearing, reading. I listened to Mark Boris kind of after the RBA rate decision as well, saying, look, I don't think we're going to see rates come down till late 2024, for example, maybe even 2025, based on what the inflation data is looking like as well. So that baked in is just going to be like, well, if we get a rate cut, we're just going to end up to where we were kind of pre-November.
I look at it from the investor point of view, where like the data is the strongest it's ever been. Like unemployment's ridiculously low. Rent increase is really high. Vacancy rates are all-time low. Like
low supply, high migration.
Yep.
Like, well,
everything on paper is really, really strong.
Correct.
So that's why high interest rates. But I find it funny when people make predictions for interest rates. Like I got friends who work in the bank as actuaries. Like they're 99.9 in high school, the smartest people I know, and they don't even know. But
that's
then
it.
like
everyone's got an opinion.
My random mate who's a mechanic is like, oh yeah, there's going to be 2 more rate rises, then it's going to reduce next year, and then I'm just like, what do you know?
What?
Yeah, well, you saw someone talk on a podcast there, and I do. I see all the other buyers agents and brokers, and everyone makes their prediction. I don't care about that. I'm buying, when I look at a commercial property, I look at demand in 10 years' time. I go, okay, is there going to be more population growth on that asset that I'm buying? So look at census data, look at population growth trends. Cool. Yeah. Is that going to be more demand on that property? If there's twice as many people, you're going to need more car mechanics and wholesalers, fabricators, distributors. So I can guarantee clients more demand. That generally equates to capital growth, but not necessarily, because you could have high interest rates and that stifles it. But I want an asset that's in more demand. We've had wars over land for thousands of years. So if I can own a big portion of land with something functional on it, I know you're going to be all right long term. Yeah, but I'm not a high risk investor. Like I can go get 10% net yields in regional towns, but vacancy rates are 2 or 3 years. So it's not worth the risk for that one. So it's just case by case.
Yeah, nice. I like that. Yeah, I think to your point around the interest rates. So the discussion there, just for a second, would be, why are interest rate fluctuations determining your propensity to buy?
Yeah.
So take me through, and I guess that's I guess my challenge. If you're listening here, going, if you're in that mindset, going, I'll buy when rates come down, or I'll wait. For example, it's like, I think we have no vested interest in what you do when you do it. Purely, just I guess from our own experience, being years in the game, going, how many times we've sat around, we've listened to people, I'll wait, or I'll wait for things to change. It's like, I think you take the opportunity when you can to buy what you can, to buy quality, not for the sake of it. And that's something that hasn't gone out of fashion, irrespective of rate movement.
You should be planning for high interest rates anyway. Like I've always budgeted 3% higher for whatever the interest rates when I make a purchase. And I look.
And so do the banks.
Yeah. and even like my spreadsheets will go all the way up to 10% and things. So it might go higher then. I have people go, oh, what if it goes to 12%? Yeah, but hopefully inflation will do its thing and get there.
And hopefully my income's gone up by that stage as well.
But especially people buying residential and they're like, oh, I'm not going to buy it at the moment. Interest rates are too high. I'm like, you're buying this for 30 years. Like, what are you worried about now? Like, if you'd bought it 10 years ago, you would have had it like a third paid off. Like,
that's exactly
so I just focus
on paid off, it would have gone up, shot up in value as well. You probably haven't been, if you were renting, there's a sunk cost with renting as well, and the ability just to get on with life. And I think sometimes that's the intangible, which is, imagine what you could have done from a wealth position. You maybe even could have bought another investment property or two with that uplift in the equity.
You need to protect yourself. Have your buffers, run your scenarios, but there's always a reason not to buy. Like I've been a buyer's agent for 7 years now and done 1,500 deals.
Yeah.
There is always like a royal commission, removal of negative gearing,
interest only changes.
APRA lending restriction changes,
SMSF changes,
supply chain issues, war in Ukraine, Iraq, blah, blah, blah. Like there's everything. I saw a cool graph on social media the other day where it had the chart of the line going up, wiggle, wiggle, wiggle.
Yeah.
And there was like 20 different major events that people said was going to cause a crash. But supply and demand, like the supply is way less than the demand at the moment. So for the next 5 years, it's going to remain strong. Not guaranteeing capital growth. Like I said, don't trust anyone who says, oh, definitely going to get capital growth in the next year or two. But there's demand there. So long term, you're going to be okay.
Beautiful. What's next for you, mate? And personally, you're bub in tow, and I guess fatherhood has changed your outlook at all, or
probably get some sleep, as I said before I got here. I'm like, get me a coffee. I've had 3 hours sleep. Just I've moved back to Australia. Just keep catching up with friends, family. I'm going to buy a slightly upgrade camper van, something with a bit more roof height, so I can actually stand in it because I'm 6'3". Then just do the big loop around Australia and just keep working and growing the business and hopefully find some cool commercial deals.
Good on you, mate. I mean, travel always, just to kind of touch on this, gives you a bit of perspective about how good we have it here.
Yeah.
Do you feel that way when you come back here after traveling through Europe? I mean, obviously it's beautiful.
Yeah.
Not taking that away from it. But do you realize how lucky we are to call Australia home? Is that something that's resonated with you?
I do, and it's funny you mentioned that. You realise when you get back, people whinging about the things that people overseas are yearning for. Like I was based in the UK, which is grey sky, drizzle constantly.
Yeah.
And they're like, how good would it be being Australian the weather? And you get here and people are like, oh, it's too hot. And it's like, put on a singlet, put on some shorts, go for a swim. Like there's some options there. But I actually really like traveling to third world countries because it's very hard to be unhappy when you get back and you live a life of luxury.
And they're so insanely,
they're actually happier.
insanely happier. Yeah, great.
My partner used to be on the board for Lifeline in Australia.
Oh, wow.
And weirdly, the most affluent areas had the highest rate of depression. So the money and the location with lifestyle wasn't actually changing happiness. So there's something more to it than that. I think you need to self-reflect on.
Hey, spot on. I mean, we look at like wealth on paper, and then you look at wealth, and you see, and you probably meet some people. We've had plenty of people that have got some ginormous portfolios. I'm like, someone would kill for it, and they're still not happy. And I get this all the time. Bernie's a really good kind of gives me an uppercut, going, "We are lucky.
Yeah.
We may not have everything, but it's like, hey man, health." And I think the most important thing is health, whether that's mental, physical, spiritual, well-being health. Like there's so much that comes into health is wealth.
Yeah.
The last few years have taught us that. But you're right, mate. I think when you travel to third world countries, you start to realize how truly blessed we are.
I think if you just reflect well, like I get clients that find it weird that I'm not like aggressively buying properties anymore. I'm actually reducing my OVR. I actually want to get rid of debt in the next 5 years and be completely financially free. Yes, I could be wealthier in 10 years' time, but if I can't be happy on a couple $100,000 passive income per year, nothing is going to make you happy. You need to find something else in life. But yeah, I just want a powerful house, keep traveling around, just enjoy life and spend time with my little girl.
It's refreshing, mate. I love it. It's you're saying that I could turn up the dial, but yeah.
We have this discussion all the time.
Is it going to 2-3x my happiness?
Yeah.
Mate, you'll realize when you use a little girl you've got.
Yeah, little girl.
Little girl, mate, when she starts talking, she doesn't care how many properties you've got.
Yeah.
But they will care when you're not there for the dance practice, mate, and you're not around. So, mate, onwards and upwards, mate. I love chatting to you. It's real talk, Yep, commercial property, mortgage is what we do, but behind the scenes, I think what we're really talking about is there's families here, there's trying to create, make some good decisions to create some long-term wealth. But that means there's got to be some action taken. And I think that's what we're really all about is how do you take the right next step for action? So if you do want to have a chat, mortgages, if you do want to have a chat, commercial buying, we'll include details for yourself, Steve, and your team at Palise Property. Have we got that right? The Italian pronunciation?
Well, I say Palise, and we had this chat beforehand, but when I was in Italy a couple of months ago, they said it was actually Palisa, which I find hilarious because my partner's called Lisa and we're engaged, so she's going to be Lisa Palisa.
Oh, I love it. That'll go down well with her, I'm sure.
Well, funny enough, her last name's His Cock. So like it's probably not
step up.
Although she said at school she never got teased because you can't take it anywhere.
Yeah.
So like if it sort of sounds a bit dirty, kids will kind of jump on that, but you can't make His Cock worse.
I can't get any better.
So she's just like, okay, that's fine.
Nothing to see here. Keep moving on. Awesome. I want to say thank you very much again. If you found this episode helpful, please leave us a review. We've been getting some really great feedback as well from people kind of sending some emails, got a couple of LinkedIn messages from listeners. So if you are listening from the sidelines, we want to hear from you as well. It means a lot to us when you engage with our content as well. And let us know if this is hitting the spot for you. That's a wrap for another episode of the Australian Property Investment Podcast. We'll talk to you next time.
See you guys.